Welcome to the Cashflow Connections podcast. This is going to be part 2 of a 2-part series where we're talking about the frequently asked questions that investors asked when you're in the process of raising capital. Now, this is chapter 11 of my book. We just listened to part 1. So if you haven't listened to that, make sure to do that because they're put in the order they were put in for a reason. And again, if you haven't yet got my book and you're living under a rock or you're still struggling to raise capital and you want to feel like you can send one email and raise $2, $4, $5 million very quickly, it's all about putting yourself in a position where investors are chasing you down. And that's what the book is all about. You can get your copy at raisingcapitalforrealestate.com. We'll give you the book. All you got to do is pay for shipping. And this book has been purchased everywhere from New York to Shanghai to London to Los Angeles and everywhere in between. So go over to raisingcapitalforrealestate.com, pick that up, and let's get into part 2 of chapter 11 about answering frequently asked questions. What are the major risks of the offering? This is the most common question you'll receive from potential investors. Prepare to answer this question truthfully and discuss the ways in which you've worked to mitigate any potential risks. With any passive investment, the biggest risks are challenges associated with the operating partner and on-site manager. I'm transparent about this reality up front. Then I discuss some of the steps we've taken to greatly reduce the likelihood that we'll have challenges in these areas. Here are a few steps we take when conducting due diligence on an operating partner, as well as the key companies that will be involved in the management of the asset. Number 1, implement a systematized due diligence process and checklist. Number 2, run a background check on all key team members. Number 3, conduct on-site visits. Number 4, interview professional referrals, including insurers, contractors, accountants, and legal counsel. Number 5, conduct a review of the property manager's systems, processes, and software. This is a good time to share how you've explored every detail of the offering in order to feel comfortable with the opportunity and the key team members involved. Your processes are likely far above and beyond what potential investors have the time, capacity, or expertise to do, so you'll likely validate your role in this opportunity by providing this information. Something else that can also ease any investor's uncertainty is to hear that other savvy investors decided to move forward with you. Mention anyone that's invested in your offering who has an extensive background in real estate or finance or went to business school. I'd also include a high-level overview of some of the due diligence questions that these sophisticated investors asked prior to moving forward. You don't need to replay the conversation word for word, but making it clear that other savvy investors moved forward with the investment will really boost your credibility. How are your incentives aligned with investors? One of the many benefits of investing in real estate, as opposed to exclusively investing in stocks, is that investors in real estate get the benefit of being highly financially aligned with the people they're investing in. It's important to highlight exactly how you've worked to align your incentives for long-term performance as opposed to just working to get a deal funded. Here are the best items to focus on when it comes to explaining how your incentives align with your investors. Number 1, describe the percentage of your proceeds that are based on performance above a preferred return as opposed to upfront fees. Let's say you're likely to receive a 2% upfront fee for pre-close duties and an additional 1% of capital raised, on average, based on performance, only once the preferred return has been paid and investors have received all their capital back. Using this example, if the investment was a 10-year hold, that would mean that you'd stand to receive 2% from upfront fees and 10% from performance above a preferred return, which would equate to 12% of capital raised as your total compensation. In this situation, roughly 83%, 10% divided by 12% of your compensation is derived from performance. Investors will find this very compelling. Number 2, if you or someone in the GP are putting up your personal balance sheet as collateral for a loan, make sure investors are aware of that. Typically, if a bank is going to grant someone a loan for millions of dollars, they usually require that the loan guarantor provides proof that they have more than enough funds to pay back the loan if something goes wrong. Yes, it's true that most commercial loans are non-recourse, meaning that if the borrower defaults, the bank seizes the property but can't pursue the borrower personally. However, there are many cases where banks have circumvented these clauses and pursued the loan guarantor, especially if they believe the GP acted in bad faith. While the potential for making millions of dollars is certainly a motivating factor for a lot of real estate investors, doing whatever it takes to ensure that they don't lose millions of dollars can be equally as motivating. Make sure that investors understand that you and your partners are motivated by both the carrot and the stick. You have the upside of the proceeds above the preferred return and the downside that's associated with guaranteeing the loan. Number 3, if you, your friends, and your family members are investing, communicate that to potential investors. When an investor asks about incentive alignment, they're really trying to figure out how strongly you believe in the investment offering and whether or not you'll stick around if things start to become challenging. There's no better way to make your intentions clear than if you, your family, and your friends have invested. Granted, you could be dead wrong, but if you've helped the people you love most invest in the offering, it's clear you believe in the downside protection and the upside potential. Do you have any references? Providing references is a frequent request from inquisitive investors, and for good reason. Make sure you have a system in place to provide references quickly so there isn't a significant lag time between when the potential investor asks and when they're introduced to your references. Here are a few tips for providing references to an investor. Number 1, identify 3 of your previous investors as possible references. First of all, ask them if they're willing and available to act as a reference for your potential investors. Once they agree, schedule a role-play discussion to ask questions about their experience with your firm so that you can ensure they'll give you an excellent review and are well prepared for future conversations. Number 2, ensure that your references are knowledgeable enough so that they can hold a conversation with sophisticated investors who are conducting due diligence on your firm. This will help assure the potential investor that you're a quality operator who's worth making a bet on. Additionally, your more savvy previous investors will be able to speak the language of real estate and know what key points to touch on when conducting these calls, which will quickly alleviate any concerns the potential investor may have. Number 3, make sure your references quickly respond to emails and will actually follow up. It's a really poor reflection on your business if the potential investor contacts a reference and then hears nothing but crickets. Make sure you selected someone who's always responsive to emails and willing to set up calls during the business day. If a potential investor mentions that one of your references never got back to them, don't use them as a reference in the future. Granted, it can be very challenging to identify a previous investor who's the perfect combination of accredited, sophisticated, and not too busy to answer additional emails. This is why number 4 on the list is so important. Number 4, each year, individually take each of these 3 identified references out to dinner as an act of gratitude. It's always a good idea to thank the people who've helped your business succeed, but references that you can rely on to always answer their phones or emails need to be given special care and thanks. Make them feel valued, and don't be afraid to make a few 4 money sign reservations on Yelp. Of course, any way you can motivate them to continue to help you in your process is likely an excellent investment of your resources. Think thank you notes, Amazon gift cards, company swag, etc. What happens if there's a natural disaster? Unfortunately, natural disasters are a risk that one takes when investing in real estate. If they invest in enough properties over enough number of years, it's likely that they'll eventually have to deal with some adverse effects of Mother Nature. While we at ASIM have been fortunate to avoid major challenges, we've still dealt with our share of fallout from natural disasters. They're never fun. But with proper planning, insurance, and risk management tactics, you can reduce the problems they can cause in the event that something does happen. It's important to have all these in place and be able to let investors know exactly what your plan looks like. Here are a few tips for discussing issues related to natural disasters. Number 1, address the reality that the potential of natural disasters is a concern of owning any real estate property. Number 2, discuss the specifics of the insurance you've selected and how it will protect the asset as well as them as an investor. For example, if you purchased insurance for loss of rental income, specifically outline those terms. Investors find this very reassuring. Number 3, if you specifically avoided certain regions because of their susceptibility to natural disasters, make that clear. For example, the Federal Emergency Management Agency, FEMA, ranks different locations based on the anticipated frequency of flooding in the area. As a general rule, we don't typically invest in an area designated as greater than a 500-year flood zone. This is an area with a 1 out of 500 annual chance of flood. I find that simply adding details like this helps paint a clear picture to the investors that you've thought strategically about mitigating this risk. Number 4, if there are explicit reasons why your particular asset class or investment will hold up during a natural disaster, share them with investors. As an example, the mobile home park business typically isn't as susceptible to flooding as other asset classes because the homes themselves are positioned more than 12 inches off the ground. This can make a big difference when discussing this particular risk. How do I know this isn't a Ponzi scheme? I won't sugarcoat it. There is a considerable amount of fraud taking place in the investment world. Savvy investors need assurance that they will not end up on the next episode of American Greed on CNBC. As with any questions regarding potential risks, always acknowledge that the concern is valid, particularly as it relates to a passive investor's dependence on the ethical behavior of an operating partner. I found it helpful to walk investors through some of the steps you've taken that specifically address this risk and demonstrate how challenging it would be to disguise an illicit opportunity as legitimate given the scope of your process. Here are a few topics to cover when answering the inevitable Ponzi scheme question. Number 1. Discuss portions of your due diligence process that provide cold, hard facts, especially if verified by third parties. For example, if you pull the title on a property your operating partner claims to own, and the title reflects that they do in fact own the property, that would be something any investor would be interested to know. Number 2. When you visit the operating partner's currently owned properties, keep your eyes open for situations that confirm the opportunity is authentic and in good standing, then share your perspective with investors. For example, if you talk to an on-site property manager of one of these properties, and they know the operating partner well, it would confirm that they frequently visit the asset and are actively involved in its management. Number 3. Communicate any ongoing efforts that provide transparency into what's happening at the property level during the hold period. If you're planning on making additional on-site visits during the hold, let the potential investor know that you'll not only review the financials and statements provided by the on-site manager, but also personally inspect the property to confirm that its status is in line with the quarterly reports. Number 4. Mention previous investors who undertook their own extensive independent due diligence process and concluded that everything was in good standing. Number 5. Run a background check and communicate that you've done so to potential investors. Number 6. Discuss possible legal measures that can be taken if you or the operating partner act in bad faith, especially given that you're pooling investors together for the purchase of securities. As I've mentioned throughout this book, securities violations have serious financial and legal implications. Make sure investors know that if an operator should act improperly, the passive investors will be well positioned to pursue them in court, given the leverage that the legal system creates when dealing with securities. What is your track record? To answer this question as efficiently as possible, it's important to have an easy-to-read document prepared outlining the team's track record in the business. Remember, though, if you're just getting started, you'll want to promote your operating partner as the expert rather than yourself, and therefore use their track record as opposed to your own. I like to keep this document as simple as possible, with just enough detail to clearly highlight the firm's success. Here's an example layout of a track record document. Property name, asset class, purchase date, projected ROI, performance to date, and closing date. I also like to highlight the assets that have been realized or taken full cycle, so investors can see that you and your operating partner have had success in fully and successfully implementing the business plan. Anytime you're providing previous track record information, it's imperative that you state that past performance is not indicative of future results, both in the email that you send to the investor and the track record document itself. Treat this suggestion with the same level of importance as recommending that each investor refer to their own CPA or attorney prior to making an investment decision. Always remember to do it. All right, hope you enjoyed part 2 of answering investors' frequently asked questions. Remember, this is a 2-part series that is actually chapter 11 of my book, Raising Capital for Real Estate. So if you're interested in this content, you want to see the whole book, you can actually get it for free. All you got to do is pay for the shipping. So go over to raisingcapitalforrealestate.com. And when you get over there, you'll notice that you'll have an opportunity to purchase the audiobook. Yes, I narrated the whole thing. It was one of the most challenging things I've ever done. But when you buy the audiobook, you also get access to these bonus features, which include 3 conversations with real titans in the industry. Most importantly, a securities attorney that I have used for an embarrassing amount of hours that charges $600 an hour. And we have a very detail-oriented conversation for an hour about securities laws relating to raising capital. So if that doesn't entice you, go over there and buy the bonus features. I don't know what will. Again, raisingcapitalforrealestate.com. Hope you enjoyed it.